All right, we're going to go through this problem and look at several definitions. Depreciation expense. That is the annual expense that you're going to take on depreciating equipment each year on your income statement. It's an expense. Now, with our example here, ABC bought a skip loader, cost $150,000. Going to use it for 5 years and then trade it in on a new one. Used skip loaders bring in about 40% of the cost new after 5 years. So they think they can sell it for $60,000 5 years from now. The difference between $150,000 that they paid today and the $60,000 they're going to sell it for in the future is $90,000. That's the amount of depreciation expense is they will take over the next 5 years. All right, now we have multiple ways of doing depreciation. What I want to do is give you 2 examples here. Straight line depreciation takes the same expense each year. Here we have the company, they project their revenues in years 1 through 5 at $850,000. All their expenses other than depreciating this here skip loader are $750,000. So they'd have taxable income of $100,000 a year. 850 minus 750 would give you $100,000. Assume their tax rate 25%, so they owe income taxes of $25,000 on their taxable income. All right, so if they claim the total value of the skip loader right away, that'd actually be good, but they aren't allowed to do that always. So we have the company here taking straight line depreciation. We'll also look at double declining balance. Straight line depreciation, pretty simple stuff. You just take the total amount of depreciation you're going to take, and that is cost minus salvage value which would be $150,000 cost minus the $60,000 salvage value. You're going to take $90,000 of depreciation. Useful life (5 years). So if it's total depreciation over the 5 years, over the period, divided by the number of years, gives you the per year depreciation. Okay, so that'd be $90,000 divided by 5, that'd be $18,000 a year of depreciation expense. And that's what we would report on the income statement as the expense. Now I could just type in 18,000 here, but after I've done all the arithmetic. Another way of doing that is to use Excel's functions. All right, here's a financial function in here called SL. Financial. There we go. SLN, it returns the straight line depreciation of an asset for 1 period. Okay. To enter in the functions here, you got to have the cost, $150,000, the salvage, $60,000, and the life, 5. And I'll give you $18,000. That's exactly what I did over here. It's going to be the same each year. What that does is reduce our taxable income and reduce our net income. All right, so if I look over the entire 5-year period, I would have had $4.25 million in revenue, $3.75 million in everything other than the depreciation. Depreciation's $90,000. Taxable income $410,000. Total taxes $102,500. Total net income over the 5-year period $307,500, which I could have gotten just by multiplying each of these numbers by 5. Okay, so depreciation expense is the amount of expense you claim each year. With straight line depreciation, it's going to be the same amount each year. All right, how about if we use a accelerated depreciation like double declining balance? Now, your book shows you how to do the calculation, but thank God for Excel, because Excel knows how to do it. Excel knows how to do it better. So if I go up here into the financial functions and look for DDB, for double declining balance, ask me for the same cost, the same salvage value, the same life. Now, those are the exact same numbers that we were using for straight line depreciation. We call this accelerated depreciation because it takes more depreciation in the early years and less in the later years. We'll click on the number 1 up there, and this will be the amount that you'll take in the first year. So instead of taking only $18,000, you take $60,000. In the next year, you would take $30,000, okay? So again, the function here is cost, salvage, life, and now it's looking at year 2 and it's doing the calculation for us. Notice in year 3 it doesn't take any depreciation. That's because we depreciated up all the money that we were going to take. So the depreciation expense would be 0 in each of the other years. I still have $4.25 million. I still have $3.75 million of other expenses. I still have $90,000 of depreciation, but instead of being spread out $18,000 a year, it's $60,000 this year, $30,000 this year, and zeros otherwise. I'm still going to have $410,000 of taxable income. I'm still going to pay $102,500 in tax, and I will still have $307,500 of net income over the entire period. So what's the difference? The difference is that I get the same amount of net income each year here. I get less net income here, but more net income in the later years. But let's think about this as a tax flow issue. Whether I use double declining balance or whether I use straight line, I still had to pay $150,000 for the skip loader today. So the cash flow for the skip loader is independent of how I depreciate it. It's $150,000 today. If I take the expenses slowly, then I end up actually paying taxes that are the same each year. If I take the depreciation faster, it actually gets me a chance to claim my tax deduction sooner. I get lower income taxes. Instead of paying $20,500 in the first year, I only pay 10. Instead of paying $20,500, I only pay $17,500. Okay, and in the last 3 years, I pay more taxes. Do you want to pay taxes now, or do you want to wait to pay them later? Because what this company can do is it can take the money that it would have been paying IRS as income taxes and use it to invest in something else. And if the something else can make them some extra money that they can use to pay the higher taxes later, well, that'd be a good thing. You'll get this when you get into your finance classes, but that's why we make you try and learn it in accounting. The purpose from a finance standpoint is we don't want to pay taxes until we absolutely have to. Note that you pay the exact same amount, you just pay it at a different time. That's the purpose of taking accelerated depreciation.